This silver breakout is significant. This is a significant move. Even Darth Silver admits that. If it continues, then I think the answer to your question is silver outperforms and increases my urgency to add more silver to my portfolio. I'm not short, not bearish. I have some. I wish I had more. And I probably will make greater efforts to buy more silver, add more silver if this breakout continues. But remember what we said earlier in this conversation, the move in silver came at the same time as platinum and palladium and rhodium, and they all rolled over at the same time. I haven't checked today to see if when silver went back to 37, if those other silvery metals did as well. But if silver is outperforming gold this month because of its industrial side, then more Trump shock in the months ahead as we figure out what these tariffs actually do to the economy would be a headwind for silver that gold doesn't face in the next week or two. If this continues and it's something unique to silver, then I think that becomes investable.
U.S. inflation data for May offered some relief, with the consumer price index rising just 0.1% from April and remaining below 2.5% year over year for the third straight month. Volatile consumer goods, such as gasoline and eggs, dropped by more than 2% from the previous month, helping to keep inflation pressures subdued. In response, the Federal Reserve announced on Wednesday that it would keep its benchmark interest rate unchanged, maintaining elevated borrowing costs for the fourth consecutive meeting. Despite the steady inflation data, Lobo Tiggre, founder of the Independent Speculator, argues that gold remains a forward-looking indicator. He notes that gold surged toward $3,500 earlier this year, likely signaled brewing inflationary pressures well before they appeared in CPI data. According to Tiggre, gold often leads inflation rather than reacting to it, and historically, its correlation with CPI has been weak. This behavior reflects gold's role as an anticipatory hedge rather than a direct mirror of inflation statistics. Currently, the gold market appears to be in a consolidation phase, trading just below $3,400 an ounce. Still, underlying bullish momentum persists across the precious metals sector. Platinum has surged to its highest level since September 2014 on the back of speculative buying, and silver continues to attract attention as prices hover above 36 an ounce, nearing a 13-year high. Tiggre emphasizes that silver's strong performance compared to gold could be a signal for investors to consider increasing their silver exposure. However, he cautions that it's important to watch whether other industrial metals follow suit. If they do, the rally may be driven more by robust industrial demand than by fear of financial losses alone. This nuance could shape how investors position themselves in the months ahead. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Gold tends to lead inflation. So arguably, gold going to 3,500 a couple months ago led the inflation expectation that we're seeing now. So, right, I mean, you know this as well as I. If you correlate CPI and the gold dollar exchange rate, the correlation is terrible. It's not quite negative, but it's almost non-existent. And so, because gold tends to lead, so arguably the gold market sniffed this out in advance. And so now that it's here, it's not doing much. And okay, it dropped a bit. It really. If we're anywhere 33, 34, 3,500 in that range, that's a very high gold dollar exchange rate. I like to call it that instead of the gold price, because in my mind, gold is money and it's like euro dollar exchange rate. It's a Forex question in my view. So I see the fluctuation as minor. I think really these days, what's happening geopolitically, the Trump agenda, not even it's all Trump, but the weaponization under Biden before, the weaponization of the dollar and the central banks around the world diversifying their reserves into gold. These are mega trends that are happening right now, very supportive of gold. And it's interesting that, if we'd had this conversation a year or two ago, a big surprise by the Fed or a big statement by the Fed would probably have whacked gold a lot more. We'd be seeing $100 moves, something like that. But now it looks to me where we're at, the gold market is so well supported. There's such a strong bid under gold that little fluctuations like this, they just get bought. I think so based on the remarks I just made about inflation. High inflation ultimately will be good for gold. If you don't correlate CPI and gold on the wiggles, short term, but if you pull back, this. My favorite chart in this whole question area is the long-term chart of gold since 1971 and the purchasing power of the dollar, and it's a giant X. So yeah, I think that's supportive. But there's also the geopolitical environment, and again, the central bank thing can't be overstated. I mean, I think you and I talked about it when it happened in 22. That was a big deal. And maybe we didn't want to go out and say, oh, yes, this is a complete game changer. Everything's going to be different after this because, once bitten, twice shy on bold predictions like that. But that was a really big deal. You've got not just Russia or Russia and China or BRICS, but you've got central banks of allies even saying, you know what, maybe we should diversify a bit out of the dollar. And sorry, Trump fans, I don't mean to be excessively critical here. It's just he's the guy in the White House, and Trump is upsetting the apple cart with allies. So if you're Canada, say, for example, and your BFF suddenly is not ruling out war to make you the 51st state, do you really want your financial well-being entirely dependent on what's decided in New York and Washington? I think it's prudent for even your best friends to diversify it. So I think this is huge, David. This is a paradigm shift. And maybe the takeaway for this for our gold bug friends out there is that if you're worried about gold having gone so high, and you look at the chart and it's like vertical, it's reasonable after going screaming up through 2,000, 2,500 to 3,500 to worry about a pullback after that. That's what I would normally do. But if the game has changed, if we're no longer in the same context that we were before 22, then there's a case to be made that looking backward too much would be a mistake. I do think it's not just playing catch up. And by the way, if it is playing catch up, your diehard silver bulls will tell you that silver, and I agree, this is another statistical fact, is true. Just look in a typical bull market, or no, in all past bull markets except one, silver has lagged gold at first and then more than caught up on a percentage gain basis at the end. The except one was the crash of 2020. So yeah, it's reasonable to say that at some point silver, statistically, the odds are that silver at some point will play catch up and more than surpass gold on a percentage gain basis. But that's the blow off top at the end of the market. So if that's the argument you're making now, that silver is going in that blow off top phase, you're saying this bull market's almost done. I don't see anything in the fundamentals to support that case. And the other thing is, silver, as you and I are speaking, and went back over 37, but that's the second time. A week and a half ago or so, it did it before. And there are a lot of silver bulls out there like, yeah, this is it. It's going straight to 50. And I got rotten tomatoes thrown at me for saying, well, maybe, but maybe not, and then it corrected, not in a big way, but it struggled. And I think what you just said in the end of your question is really important. When you see silver and gold moving in opposite directions, this silver breakout is significant. This is a significant move. Even Darth Silver admits that. If it continues, then I think the answer to your question is silver outperforms and increases my urgency to add more silver to my portfolio. I'm not short. I'm not bearish. I have some. I wish I had more. And I probably will make greater efforts to buy more silver, add more silver if this breakout continues. But remember what we said earlier in this conversation. The move in silver came at the same time as platinum and palladium and rhodium, and they all rolled over at the same time. I haven't checked today to see if when silver went back to 37, if those other silvery metals did as well. But if silver is outperforming gold this month because of its industrial side, then more Trump shock in the months ahead as we figure out what these tariffs actually do to the economy would be a headwind for silver that gold doesn't face. And if that doesn't happen, if that's not what's going on, and silver leaves the other metals in the dust, and there's something very silver specific, shorts being liquidated or whatever it is, if this is an unusual time to ask a question like this, David, what I'm saying is we might know in the next week or two, if this continues and it's something unique to silver, then I think that becomes investable. It would change my marching orders what happens in the next week or two with silver. And if it confirms, that's very bullish, increases my urgency to buy. If it doesn't, then it tells me, let's wait for Trump shock.
With the Federal Reserve once again leaving interest rates unchanged, Chair Jerome Powell delivered a cautiously optimistic message during his post-meeting press conference on Wednesday. Powell acknowledged that recent data has been encouraging, citing 3 consecutive months of favorable inflation readings since January. However, he also noted that goods inflation has begun to tick higher, a trend the Fed expects to continue through the summer. When asked about the evolving impact of tariffs, Powell acknowledged that while their influence has been limited so far, the broader effects remain uncertain. The size of the tariff effects, their duration, and the time it will take are all highly uncertain, he said. Given these uncertainties, Powell emphasized that holding rates steady is the most prudent course of action for now, maintaining a flexible position for the Fed to respond to future developments. Lobo Tiggre interprets Powell's reserved tone as a quiet acknowledgement of growing risks. While Fed chairs typically avoid projecting alarm, Tiggre believes Powell's remarks reflect an underlying concern about inflation. The Fed also revised its growth forecast downward, pointing to a possible stagflation scenario where the economy faces both rising prices and slowing growth. Let's get back to the interview.
Bearing in mind that this is the chair of the Federal Reserve, he's never going to say, oh my God, head for the hills. That's not going to happen. So for him to even admit, and not just admit, but like everybody he knows is saying meaningful inflation is on the way. That's really quite striking. At the same time, the Fed also lowered its growth projection. So what he didn't say, but what this implies is a stagflationary outlook. They're looking at weaker growth and higher inflation. And okay, it's going to be passed through. He didn't use the word transitory this time, though he did last time. But that's clearly what they're thinking. Okay, it's the tariffs. It'll be probably one-off. At the end of the conference, he was asked, what about hiking rates? But that clearly says they're still in team transitory. That's where they're at. And that's why they're caught in this place. But that didn't work out so well for them last time. And if their own numbers, this isn't tinfoil hat Lobo, the independent speculator, this is, the Feds and all those responsible people that he talks to are seeing this inflation on the way and this, the cracks in the labor market that were also brought up. That's essentially stagflationary. And it's interesting to me that during Powell's press conference, you could see the markets bouncing around. Right when the FOMC statement was released, and this is a bit of tea leaf reading, but bear with me for a second. When the statement was released, basically nothing happened. Everybody was fine. There were still 2 rate cuts on the dot plot for this year, and the Fed didn't do anything. Everything was more or less as expected. But then when Powell started talking, suddenly things went down. All 3 of the major U.S. indices dropped right away. And I think it has to do with this issue that you brought up and the admissions that the number of times he mentions uncertainty and that they don't know what's going to happen and that the economy faces headwinds and that there is this inflation coming, right? I think the markets were hoping for something more reassuring, but what they got was a bit of tough love. So when they say expectations, they mean they're not talking about their own dot plot and they're not talking about market pricing. They're talking about the ones they say are important now. Before Powell keeps moving the goalposts, right? Before the consumer expectations from the University of Michigan, that was a very important data point. But now recently it hasn't been supporting their conclusion. Suddenly, that's just soft data. We don't pay attention to that. But the expectations that Powell says are important are these long-term ones. And he admitted that near-term inflation expectations are higher than they were before. And the very latest print was that they're down, significantly. People are less afraid of tariffs now. The shock is kind of worn off a little bit. But that was this last month. Since the last Fed meeting, the expectations are up. And so he dismissed that. Oh, that's just the near term, the next year or two. But the important ones, those are the 5-year and longer ones. But it's interesting that he never specifies which data he's looking at. He says, most of the long-term expectations are still well anchored around our 2% goal. Which ones? None of the ones I can see, even the University of Michigan one, if you look at their 5-year, it's still like 4% or so. It's like twice their supposed goal, not well anchored near their goal by any stretch of the imagination. So, what the hell is he looking at? I don't know. I don't know anybody who does know. So it seems like, the constant goalpost moving is maybe to be expected, but at some point the market has to call BS on that. And this is where, the bond market vigilantes, it seemed like for some years that they were just asleep at the wheel, but recently the bond market has been, upsetting the apple cart here. And it'll be interesting to see if there's some accountability going forward. Even the mainstream admits that with all the stockpiling, the front running of the tariffs, and we saw that. The data is very clear on that. There was a huge amount of rushing to buy and import before the tariffs hit home. And so now you might say, well, gee, okay, so they bought all that stuff, but the inflation is coming. So why aren't sellers raising their prices now? Well, at the same time, you've got Trump lowering 145% tariffs on China to 120 to whatever it is now. We don't even know. You've got a deal with the UK, maybe a deal with the EU. There's an expectation that the deals that Trump cuts are not going to be at the level of the tariffs, which are supposed to be, it's funny, July 9, the end of the 90 days, prolongation, that's almost upon us. But there's an expectation that the actual tariffs are going to be less than the so-called reciprocal tariffs initially announced, right? The dog's bite will be not as bad as his bark. And so if you're thinking, well, it's going to be better, it's not going to be so bad. You don't know what's going to be. So why would you change your prices? And B, if you think it's going to be lower, well, maybe you eat that margin because it won't be so bad. And the other thing is we've had pushback from the courts. So if you're thinking, oh man, my input costs are higher, I got to raise my prices, but hey, maybe the courts will smack this down and I won't have to. Why upset your customers? Why raise your prices and lose sales if a week from now or a month from now, the courts or the deals might lower the tariff rates? So I think we've got front running in supply and inventory, and we've got very good reasons for producers and sellers, people along that chain, to hold off on raising prices if they don't have to. That's really a last resort. You don't want to do that unless you have to. So I'm not surprised that it's taken longer for this to show up. You asked me if I agree with the mainstream on this. Yes, I do. I do think that inflation from this is coming, but I understand the technical reason why Powell dismisses it. If you have a one-time increase, like the new rate is there, the higher price is there, and then it goes up. Inflation is a rate. It's a rate of change. So by definition, a one-time change in price, once that's in, there's no rate of change anymore. It's steady state after that. So you can say, oh, that's not just inflation. That's not inflation. You can dismiss it. But the reality is for the person who goes to the store, they don't care whether inflation is technically a rate of change or not. They go to the store and prices are higher. That's what they care about, and they're not going back down again. So on the one hand, technically I can say there's a reason for Powell to say what he's saying, but the reality is people aren't going to be happy when those prices go up. And the other reality that's kind of not acknowledged is, okay, that's this round. Well, what about, the responses, and what about the knock-on effects? They say, oh, the tariffs are one time. That's an assumption. They may not be, and we'll see. So I do think we're going to see this higher inflation, or this bout of inflation near term. I think that's coming off. And then after that, you've got the great big beautiful bill. You've got money helicopters in the air. I think all paths lead to higher inflation farther ahead. And really, ultimately, David, whatever the answer right now is, the bigger picture here is that Trump's agenda is inflationary. Doge did not save us $2 trillion. Sorry, I was all in favor of that, but it didn't happen, right? And we're raising the debt ceiling so it almost doesn't exist anymore. We're spending trillions and trillions. Maybe some years down the road, greater efficiencies, AI, who knows, might help. But for the foreseeable investable future, the outlook is inflationary regardless. And that's good for the commodities that you and I and our audience care about. A bunch of construction workers agreed with Trump that interest rates should be 250 basis points lower. QED, we're done here. The argument's settled, right? Well, hey, that would save money. Fire all those hundreds of PhD economists they have at the Fed. I kind of like that idea. But, this is interesting. I mean, to me, this is Trump being Trump. He's on camera. He is a TV personality, was long before he was president. And whatever you think about Trump, love him or hate him, or whatever, he's not entirely ignorant. There is no way that he can not know that the Fed dropping interest rates 2.5%. I mean, never mind a jumbo or a mega cut of, never mind 50 points or 75 points, but 250 points at once, that would tank the markets. That would signal absolute panic and mayhem. Oh my gosh, that would be such an emergency move that I don't think there's any way Trump doesn't know what would happen if Powell did as he suggested today. So he's saying it for his audience. I think this is just Trump being Trump, speaking to his base. And it makes sense. Oh, gee, if interest rates were lower, the debt would be better. But the consequences of doing that, he says, oh, well, we save $800 billion for what? For nothing, just for tweaking the rate. Well, it's not for nothing. If they did that, aside from the immediate panic reaction, the stimulatory effect, the inflation that would cut loose, I think, would be even more. And, Trump says, oh, I just got here and they threw eggs at me. Well, imagine the eggs he'll get if, he puts somebody in the Fed. And actually, I'm not even sure him replacing Powell would help. The committee votes. So if you get somebody in there who's just a Trump puppet, who does whatever Trump says, and nobody else on that committee agrees with him, I'm not sure Trump gets what he wants anyway. And, that could actually be a good thing. Institutionally speaking, if the president couldn't just, browbeat the Fed into doing whatever it wants, I think the Fed should be abolished, actually. But in terms of divisions of powers, I think the Fed should be able to stand up to the president. Anyway, my reaction to this is I think you can't take that at face value. Like they say, take Trump seriously, but not literally. And I think that new conventional wisdom is wise in a case like this.
Despite headline inflation appearing calm, deeper market indicators suggest that underlying economic stressors may still be brewing. Precious metals, particularly gold and silver, continue to act as barometers of investor sentiment, While central banks strike a cautious tone and maintain their wait-and-see approach, the rally in metals like platinum and silver suggests broader forces are at play, including renewed industrial momentum and shifting confidence in traditional financial instruments. The convergence of these signals may indicate an inflection point in both market psychology and macroeconomic direction. Are precious metals signaling a quiet shift in market confidence that central planners and headline data have yet to acknowledge fully? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.